My name is Tricio. I am Chief Strategist at Tricio Investment Advisors. Back in early March, we looked at the S&P 500 and noted that there was a good risk of seeing the 50-week moving average being tested. The U.S. war in Iran was shocking energy markets, and we said this is going to be a potential problem for bonds, central bank policies, inflation measures, and all the above, depending on how long the war lasts and how high energy prices go. This is more or less what's happening now. Even with the last week, we saw a bit of a reprieve in sentiment. I'm not sure this is going to last this week. The headlines of the weekend have not been ideal. And basically, we're all waiting around to see what Trump does or doesn't do to end this war. Technically, we're looking at the 50-week moving average being put under pressure. And unless we actually see the S&P 500 moving substantially back above the nearest top red line and or 13-week moving average, which would be around the 6,780 area, then there's probably decent risk that we see a drop back towards the blue line and maybe even lower to the April 2025 lows. Let's take a look at the shorter term chart to see what's going on. On the shorter term chart, again, it's still a weekly semi-log with 13 and 50-week moving averages. You can see the predicament we're in. Last week was actually quite positive. We had a nice bounce on the test of the 50-week moving average, and you could actually make a case for a pullback to the 13-week moving average near, like I said, 6,780, and maybe resuming the bull trend. That would be ideal. So what's the risk? The risk is we drift down lower, we start filling in gaps, we test the blue line, and then we go to the April 2025 low, which would put us just below 5,000, the 4835 area. The bigger risk, though, is that we actually pull back to the bottom of that bull channel, and that would be just above 4,200. That's a significant fall from current levels and something to be aware of. Again, we would reiterate, for most investors and fund managers, time in the market is much better than timing the market. However, in the near term, there are significant risks facing the market. So what do we need to see happen? One is some sort of positive sentiment or news builds, and any sort of signal that something is happening would probably see oil prices knocked down sharply, and that would lift equity market sentiment and lift bonds prices as well, which should see bond yields sink and Fed rate cut potential brought back into 2026 in a meaningful manner. At the moment, we're watching energy markets. We're back to square one in sentiment. It seems, I would say, watch out for tests of support. If we start breaking to new cycle lows in the S&P 500, then beware there could be significant downside risk down to the 5,400 area where that blue line comes in. Thank you for listening. If you'd like further information, contact us at info@tricio-advisors.com. We can talk you through subscribing to our research insights. You can also ask us about our Ask a Buddy service, where we help our professional clients manage risk and build resilient portfolios. You can read our blogs at tricio-advisors.com as well, and you can subscribe to our YouTube videos and shorts as well.